So I just did that video. I want to say it was, yesterday or whatever. And it was something like, five market experts are all basically saying we got major market problems coming. We want to step out. We want to just sell off everything we have. This is not looking good. And I can't remember right now off the top of my head. Was Paul Singer one of those guys? It may have been. But Zero Hedge has a good article here. Paul Singer warns all hell will break loose. It took Paul Singer's Elliott Management less than 24 hours, because I can remember this thing where he raised $5 billion. I think it was him. It took him less than 24 hours to raise $5 billion earlier this month. However, it is safe to say he won't be using any of that cash to buy stocks at current prices, or even BTFD, which is buy the effing dip. Instead, he writes in his Q1 letter to investors, the legendary hedge fund manager thinks, quote, that it is a good time to build a significant amount of dry powder, end quote. The reason for that is if, or rather when, Trump's pro-growth agenda fails to be implemented. He says all hell will break loose, and that a recession looms as the artificial crutches propping up risk assets are pulled out. Now, what did I just tell you recently? Obamacare plan, the repeal and replace, has been nixed for now. For 90 days. We're not going to touch that until 90 days from now, which, as I said, puts us smack dab right around September. End of fiscal year, normally October, September timeframe. That's when markets tend to crash historically. It also happens to be the September 23rd date, and I want to give you a little bonus. Someone sent me an email. Jay Snip, do you know that 2017 is the Phoenix, the year of the Phoenix? No, I did not. Let me click on that link and do a little research. Year of the Phoenix. It's like the fiery chicken or fiery rooster or something, but it's called the fiery phoenix. It just so happens to be this year, 2017. Phoenix on the front cover of the 1988 Economist magazine, rising from the ashes of burning paper dollars with a giant gold coin around its neck, says 2018, and get ready for a new world currency, or a world currency. And when I read you what was inside that particular article, the cover, the actual article, it talked about this new currency that would come on, and let's just call it the Phoenix currency, they said. So the Phoenix currency could do this and that, and people will want it because of this and that. Really? In 2017 is the year of the Phoenix. And that article was 29 years ago. But let me go ahead and continue here. Given groupthink, this is what he said. Given groupthink and the determination of policymakers to do whatever it takes to prevent the next market crash, we think that the low volatility levitation magic act of stocks and bonds will exist until the disenchanting moment when it does not. And then all hell will break loose. Don't ask us what hell looks like. A lamentable scenario that will nevertheless present opportunities that are likely to be both extraordinary and ephemeral. The only way to take advantage of those opportunities is to have ready access to capital. Isolating the impact of the Trump put, as described recently by Deutsche Bank, Mr. Singer writes that although the growth agenda of the Trump administration is slow to get off the ground, markets still anticipate that much of it will be enacted sooner or later. And yet, according to most metrics, the Trump trade has already been priced out of most markets, with the notable exception of equities, which, as Bank of America pointed out in a note last week, are now the last one standing. So again, we've kicked the Obamacare repeal and replace out 90 days now. And as I've said, everything they were saying, I'm talking about the Trump team and people just discussing it who looked into all this, for his tax plan to work, they must repeal and replace Obamacare first, because it ties directly in to the tax plan in some way, shape, or form. It frees up $1 trillion or something like that. So they've got to take care of that first. Then they can go to the tax plan, such as the major dropping of corporate taxes, the rates anyways, which is a great thing for businesses and you and me and everybody else. So if we're pushing that 90 days, Obamacare replacement, and then the tax thing comes next, we're at the end of the year. Perfect timing for the markets to say, oh, I guess it's not going to happen. Or Maybe they pull it off. They pull a rabbit out of their hat. But this guy doesn't think so. Let me scroll down a little bit. What was that? Okay, Elliott's. Oh, first of all, which Elliott? What we got here? Doesn't say which Elliott. Anyways, Elliott's warning, or was that his name? Hang on. Yeah, Paul Singer's Elliott Management. That's the company. Elliott's warning of a negative reaction in equity markets if Trump's economic policies are not delivered takes place as the U.S. Congress debates how to fund proposed tax cuts for individuals and companies, and whether lawmakers are prepared to blow out the budget deficit as Trump's plan would. So far, all of Trump's various economic initiatives appear to have stalled permanently in Congress, with the market giving pricing in little possibility of their passage. In this context, Singer warns that, quote, there are actually forces in place that could point to a relatively near-term recession in the absence of solid new pro-growth policies, end quote. And with rates already at ultra-low levels, the Federal Reserve won't be able to provide a sufficient quantitative easing cushion as it did during the Great Financial Crisis, which is why, absent a pro-cyclical push, the U.S. economy may have no choice but to contract. In case you haven't seen the numbers that I keep yelling about all year long so far, the economy is not looking good. Which is ironic because Singer, a prominent Republican donor, originally staunchly opposed Mr. Trump as its candidate before meeting the president at the White House in February, where Trump claimed he's given us his total support. The manager of $32.6 billion in AUM once again points to his favorite nemesis, the Federal Reserve, and says that, quote, we live in a time when extraordinary worldwide monetary policies have created bubble after bubble, end quote, warning that QE has done nothing to address the fundamental issues of the economy. Singer said that rising sovereign and private debt loads will come back to haunt the markets and policymakers. Expounding on a popular theme from his previous letters, Singer said that not only has the mess from the great financial crisis not been cleaned up, but all the wrong measures have been used to address the problem. Since the GFC, we have believed that the extreme monetary policy, zero interest rate, negative interest rate, quantitative easing, prevalent throughout the developed world was unsustainable and risky. He explains, as he has done every other quarter since 2008, that the solution to a crisis resulting from financial engineering is not more financial engineering, but addressing the real issues that caused the problem to begin with. That has not been one, and instead the solution to over-indebtedness should not have been the creation of more debt, and the problem of inadequate growth should not have been solved by money printing and zero and negative interest rate. Singer also blames failed policies for the current breakdown between heightened geopolitical risk and record low volatility. Quote, on the face of it, year after year of the unusual and risky policy mix has not caused the collapse of any major currencies or significant inflation other than in asset prices, resulting in a world that has been put to sleep by pervasive complacency. This seeming lack of empirical proof of the lurking danger has lulled most investors into thinking that the elevated prices of stocks and bonds and the historical fall in price volatility in financial asset markets is somehow a permanent condition. To be sure, Singer has been one of the most outspoken market skeptics during the central planning phase of markets, issuing periodic warnings about China's debt-fueled boom and price bubbles in financial markets, inflated by central banks, 0% interest rates, negative percent interest rates, and bond buying policies of central banks. Maybe this time will be different. Even so, Singer's stated skepticism has not prevented him from outperforming not only the S&P in recent peers, but the vast majority of his peers. That doesn't make sense. In recent peers. How about in recent years? So what is Singer's advice for today's investors? In a time of historic market complacency, Singer believes that The trick in such periods is to keep out of trouble. Eventually the markets wake up, and when they do, that is when all hell will break loose. When that moment comes, Singer is confident he will be ready. So essentially what he said, what I'm getting is, we're going to take our money out, no more risk. Let's take it out for a little bit, sit on the sidelines, and see what happens here in the near future. And as soon as we see that temperature gauge, so to speak, starting up, market's falling, that one's falling. Okay, let's get in and essentially write it down. They're going to short it, do whatever they want, and write it down. Again, these are what most people would call the expert of experts. These people, again, manages, what was it, $32+ billion? That's the fund he manages. Well, that's a tiny bit of money, $32 billion. And I just did the video the day before about the 5 experts. Again, I think he may have been included in that, who are saying essentially the same thing. Who wants to be involved in a market, in anything in which it's absolutely manipulated by somebody who's never supposed to have been manipulated to begin with, but because extraordinary measures have happened, we have to do so, even though they're not actually telling us that. They're just doing it anyways. You want to trust your money in that? You want to trust that they'll be able to just continue doing that forever? Nothing lasts forever. That's the old saying, right? Nothing lasts forever. So, again, I'd rather put my money in precious metals, and especially now lately, cryptocurrencies. And if by chance you missed my video last night, not only one exchange in China, but someone posted a link, a second exchange, a large one, for cryptocurrency trading, are now both allowing Ethereum to take place. I believe the one I told you about takes place, well, the day you're reading it today, sometime. It may have already started by the time you see this video, I'm not sure, but sometime today supposedly. And the next one, the other exchange, allegedly, from what I read, is June 1st or so. It'll be live as far as Ethereum trading. So I urged everybody last night, again, if you want to play a little risk, be a little frisky, if you will, and take some Bitcoin and transfer them, convert them right now, which I said last night, into some Ethereum. Ethereum is back up. It is already back up to where it left off when we had this big drop here recently. Bitcoin was at $2,800. It has not come to that level again. It's around $2,200 to $2,300. It's hovering around there. Ethereum, on the other hand, has gone up and up and up again, rapidly erasing the losses. If these two Chinese exchanges open up in the next few days, and they supposedly are, I mean, that's what they said. That's what the announcement was from them. That means a lot of Chinese are going to get involved in trading and buying Ethereum. Which means what? The price, in theory, should go very, very, very high. Should go very high in the very near future. And funny enough, the Webbot has called for just such a thing. Watch the month of June. Both Bitcoin and Ethereum, but Ethereum was mentioned for sure in the latest $99 report that Cliff High has released, which I've already, and I can make it very simple for people. I don't want to get it up and down and switch this and so. Okay. 50% Bitcoin, 50% Ethereum. Sit back, enjoy the ride. Don't do anything else. That's making it easy for you. I'm kind of doing that, but I'm deciding too, you know what? I want to play a little risky with this stuff. Hell, you only live once. This is not a manipulated market by the elite. They don't have the same tools like they do on Wall Street and their ETFs and their derivatives contracts and their futures contracts and options. Nope. You either buy the damn cryptocurrency or you don't. You don't have an overlying derivative contract that you can flood the market, sell orders, and print them at will whenever you want, and flood them again and push the price down and back off. Nope. You're either going to go in that market and buy what's available or you're not. And if you had some giant entity that they're buying, people are going to, again, they're going to buy their way up. It's just going to go up. They're going to buy it until there's hardly anything left. And the rest of us that are holding on to ours waiting, we start to sell again. We're not selling for pennies anymore, for scraps. We know where these things belong. We're going to start putting orders out there back where they were. So I wish any government or entity out there a lot of luck dealing with these cryptos. So anyways, that was my video last night. It's a gamble. Hell, we may wake up tomorrow and the next day and the next day, 3 days. Man, Ethereum went down. It was 220 something and it actually went down. It's 190 again. Huh. That's weird. Right? And it is what it is. Do I care? No, because I know, I already told you. Webbot report. According to it, Ethereum is going to $500+ in the not so distant future. 190, 220. Exactly. Doesn't really matter. Next video. Gotta, get prepared for it right now. Take care.